Most people do not overpay for life insurance because of bad luck. They overpay because of 5 specific mistakes made during the buying process. None of these are about complicated formulas. If you have been searching for how to buy life insurance or how to calculate life insurance premiums, here is the part nobody tells you. The biggest savings come from decisions you make before you even see a quote. So in this video, I'm going to walk you through all 5 mistakes and how to avoid each one. The most common life insurance buying mistakes in India are inaccurate health disclosure, choosing the cheapest quote without checking the claim settlement ratio, delaying the purchase, skipping riders to save a small amount up front, and not comparing online versus agent channel pricing for identical cover. Let us take them one at a time. The first mistake feels like a saving, but it's not. Some buyers underreport their smoking, a health condition, or family medical history because they know how term insurance premiums are calculated and want the lower rate. Here is the problem. Your application is the foundation of the contract. A non-disclosure discovered later can put your claim itself at risk. And that is the one outcome the entire policy exists to prevent. Now flip it around, because the honest route is genuinely powerful. Disclose everything accurately and the law works for you. Section 45 provides a 3-year contestability window after which a life insurance policy cannot ordinarily be challenged on grounds of misstatement, non-disclosure, or fraud, subject to the provisions of the Act. Honest answers might mean a somewhat higher premium today. What you get in return is a payout your family can rely on. Mistake 2 happens at the comparison stage. When 5 quotes sit in front of you, the lowest number pulls hardest. But how to buy life insurance well is not about finding the lowest premium. It is about finding reliable cover at a fair premium. Few checks tell you far more than price. First, the claim settlement ratio. That is the percentage of death claims an insurer paid out of all claims received. Published every year by IRDAI for every life insurer. Look for higher claims settlement ratio consistently across recent years, not one good year. Second, the solvency ratio. In plain terms, this is the insurer's financial cushion, its ability to pay claims even in a bad year. IRDAI requires every life insurer to maintain a solvency ratio of at least 1.5. Both numbers are public. 5 extra minutes of checking protect a 30-year decision. Mistake 3 is the quiet one: waiting. Most people delay because nothing forces the decision. I will buy after the increment, after the wedding, next year, etc. What makes the delay expensive is one feature of how pricing works, and you do not need the full formula for it. Your premium is locked at the age you buy, and it stays at that rate for the entire term. A 25-year-old non-smoker pays roughly half the premium of a 35-year-old for the same ₹1 crore cover. That difference is not paid once. It repeats every single year for decades. And there is a second cost hiding behind the first: health. You will never be more insurable than you are today. And a condition diagnosed during your waiting period can raise the price or complicate the purchase. Buying early is not an urgency for its own sake. It is simply the cheapest year you will ever get. Mistake 4 is a false economy. At checkout, riders look like the easy thing to cut. A rider is an add-on to your base policy. A critical illness rider pays a lump sum on diagnosis of a listed serious illness. An accidental death benefit rider pays extra over your base cover if death is due to an accident. And a waiver of premium rider keeps your policy running with premiums waived if disability or serious illness stops you from paying. Skipping these saves a small amount each month. One hospital event can cost more than a decade of rider premiums. The decision is not premium versus no premium. It is a small known cost now versus a high unknown cost later. Evaluate riders on your actual risks, your health history, your loans, your role in the family, and cut only what genuinely does not apply to you. The last mistake is not comparing how you buy. The same insurer can price identical cover differently across channels because the costs of distribution differ. ABSLI's own comparison of online and offline purchase notes that online policies are generally priced lower since the insurer saves on distribution and administrative costs. That does not make one channel right and the other wrong. An advisor adds real value if you are a first-time buyer or your situation is complex. And the claim process is identical either way, governed by the same IRDAI regulations. The mistake is only in not checking both. Before you decide, run your numbers through a term insurance premium calculator or an insurance premium calculator online. Get an offline quote for the same cover and compare. Whichever route you choose, you will choose it knowingly. If you want to put all 5 lessons to work in one place, ABSLI's online buying process walks you through full disclosure step by step, shows rider options with costs upfront, and gives you a premium quote in minutes through the calculator on the ABSLI website. The link is in the description. At the start of this video, I said most people overpay because of 5 specific mistakes. So let me leave you with direct answers to the 3 questions that decision actually hinges on. Can I correct a health disclosure mistake after my life insurance policy is already issued? In most cases, you should inform your insurer of any material change or correction as soon as possible, even after the policy is issued. But failing to disclose material facts can affect claim settlement later, regardless of when the omission is discovered. Is it cheaper to renew an existing life insurance policy or buy a new one at a higher age? It is almost always cheaper to retain and pay premiums on an existing policy than to buy a new one later, since your original premium is typically logged in at the age you bought it. A new policy purchased at a higher age will be priced based on your current age and health status, which is usually higher. Do online life insurance policies have a different claim process than agent-sold policies? No, the claim process is identical regardless of how the policy was purchased, since it is governed by the same IRDAI regulations and the same insurer's claim procedures. The only difference between online and offline purchase is typically the distribution cost reflected in the premium, not the claims experience. Overpaying for life insurance is not a pricing problem, it is a process problem. And now you know all 5 places the process goes wrong. Disclose fully, check the ratios, buy early, keep the riders that fit your life, and compare both channels. If this helped, like the video, subscribe, and check the description for the ABSLI calculator and our full premium calculation video. Because how to buy life insurance, well, comes down to avoiding the 5 mistakes you just learned.